Today, we will take a closer look at Apple, the world's leading technology company in premium consumer electronics and ecosystem-based innovation. Best known for its tightly integrated ecosystem across iPhone, Mac, iPad, wearables, and services. With a massive installed base and strong brand loyalty, Apple continues to deliver resilient growth and industry-leading profitability. In Q1 fiscal year 2026, Apple reported revenue of $143.8 billion, up 16% year-over-year, driven by steady growth across both products and services. The iPhone remained the largest contributor, while services continued to expand as a high-margin growth engine. Gross profit reached $69.2 billion, with a gross margin of 48%. Operating income totaled $50.9 billion, while net income came in at $42.1 billion. EPS reached $2.84, slightly above market expectations, underscoring Apple's strong earnings power. When looking at Apple's revenue structure, total revenue has increased from around $111.5 billion in early 2021 to $143.8 billion by early 2026, reflecting steady long-term growth despite cyclical volatility in hardware demand. iPhone remains the core revenue pillar, generating $85.3 billion, or nearly 60% of total revenue. Meanwhile, Mac and iPad revenues have remained relatively stable, reflecting post-pandemic demand normalization rather than a structural slowdown. Notably, services continues to be the fastest-growing segment, reaching $30 billion, with a CAGR of approximately 13.7%, compared to 3.5% for products. Services is increasingly becoming a key driver of Apple's long-term growth and margin expansion. Next, we take a broader look at the global smartphone market. After peaking at around 1.5 billion units in 2016, global shipments declined and stagnated for several years. From 2024 onward, the market has started to recover modestly, with shipments growing by around 2 to 3% year-over-year, supported by replacement demand and improving macro conditions. Within this environment, Apple strengthened its position and overtook Samsung in 2025 to become the world's largest smartphone vendor by shipments, capturing approximately 24% of the global market. Despite its focus on the premium segment, Apple's shipment volumes have remained stable at around 230 to 260 million units per year, highlighting the resilience of its ecosystem. While Android vendors remain more exposed to volume and pricing pressure, Apple continues to differentiate itself through pricing power and ecosystem monetization, positioning the company to benefit from premiumization rather than volume-driven growth as the market stabilizes. Over the past decade, the global PC market has gone through several cycles. Shipments peaked at around 365 million units in 2011, before declining to roughly 260 million units by 2018, largely due to the rapid adoption of tablets. During the pandemic, shipments surged to approximately 349 million units in 2021, driven by work-from-home demand, before correcting in 2022 and 2023 as demand was pulled forward. By 2025, the market entered a recovery phase, with global PC shipments rebounding to around 270 million units, up approximately 9% year-over-year. Within this environment, Apple outperformed the market, growing Mac shipments by over 10% year-over-year and increasing its global PC market share to around 9 to 10%, driven by the transition to Apple Silicon, Apple's in-house chips. The tablet market was established with the launch of the iPad in 2010, before entering a prolonged slowdown as phablets, or large-screen smartphones, increasingly cannibalized tablet usage. Following a pandemic-driven uplift in 2020 to 2021, demand gradually normalized amid longer replacement cycles. By 2025, global tablet shipments recovered to around 160 million units, growing at a mid-single-digit year-over-year rate. Apple remained the clear market leader, shipping approximately 60 to 70 million iPads, equivalent to around 35 to 40% global market share. well ahead of Samsung. Supported by its broad product lineup and deep ecosystem integration, Apple continues to dominate the tablet segment despite a mature market. Next, we turn to the wearables and smart home markets. In wearables, the market has shown steady growth in recent years, with global revenue reaching approximately 85 to 90 billion US dollars. Within this segment, Apple remains the clear revenue leader, capturing around 33% of total market revenue, primarily driven by Apple Watch, AirPods, and newer wearable devices such as AR/VR and smart glasses. Overall, Apple's wearable devices account for more than 80% of revenue within the wearables, home, and accessories segment, highlighting that growth in this segment is largely driven by personal devices. In smart home, global market revenue reached approximately 135 billion US dollars in 2025 and is expected to continue growing at a double-digit CAGR in the coming years. However, Apple's market share in smart home remains relatively small as the segment continues to be dominated by Amazon and Google in terms of device penetration. Apple participates selectively through HomePod, Apple TV, and the HomeKit platform, with a strategy focused on ecosystem integration and user experience, rather than scale-driven expansion. Over the past decade, Apple's services business has transformed from the iTunes era into a broad, recurring revenue platform spanning content, payments, and cloud services. Quarterly services revenue increased from around 2 to 3 billion US dollars in 2010 to nearly 30 billion US dollars by 2026, making it one of Apple's fastest-growing and highest-margin segments. This growth has been driven by key launches, including iCloud, Apple Pay, Apple Music, and later Apple TV Plus, Arcade, Card, and Fitness Plus, while the introduction of Apple One bundles in 2020 accelerated cross-service adoption. By 2026, Apple reached over 1 billion paid subscriptions, supported by more than 2.5 billion active devices globally. The App Store now attracts over 850 million weekly visitors, and Apple has paid more than 550 billion US dollars to developers, highlighting the scale and durability of its services platform. Heading into 2026, Apple's strategy can be distilled into an ecosystem built on devices, monetized through services, and enhanced by AI. At the center is the iPhone, which continues to contribute around 55 to 60% of total revenue and serves as the primary entry point to Apple's ecosystem. With an installed base of approximately 1.5 to 1.6 billion iPhones, Apple benefits from industry-leading switching costs. The 2026 upgrade cycle is expected to be supported by on-device Apple Intelligence, AI-driven camera features, and new generations of Apple Silicon. Mac and iPad play a supporting but strategic role, anchoring productivity and creator workflows, particularly in AI-native use cases such as coding, design, and video, across an installed base of roughly 700 to 800 million devices. In wearables, Apple Watch and AirPods are no longer primary growth engines, but continue to deepen ecosystem engagement, especially in health, voice AI, and ambient computing. XR and smart glasses remain early stage and represent long-term optionality rather than near-term revenue drivers. Above the device layer sits services, Apple's core monetization engine, delivering over 70% margins, more than 1 billion paid subscriptions, and supported by around 850 million weekly App Store visitors. Finally, Apple Intelligence functions as an intelligence layer across the ecosystem, combining on-device processing and private cloud AI to increase engagement, reinforce upgrade cycles, and extend lifetime value over time. Next, we take a closer look at Apple's gross profit by segment. Starting with products, gross profit remains the larger but more cyclical base, ranging from roughly 22 to 40 billion US dollars per quarter, before rising to 46.3 billion US dollars in Q1 2026, driven by strong iPhone 17 demand, a higher Pro and Pro Max mix, pricing discipline, and fixed cost absorption during the launch quarter, lifting product gross margin to around 41%. Turning to services, gross profit more than doubled from $10.8 billion in Q1 2021 to $23.0 billion in Q1 2026, with margins expanding to approximately 77%, reinforcing services as Apple's core profit engine and a stabilizer for overall earnings. Looking at Apple's operating expense structure, it is clear that the company continues to prioritize long-term innovation through higher research and development spending. From early 2021 to Q1 2026, R&D winking and laughing expenses increased from around $5.2 billion to approximately $10.9 billion per quarter, implying a compound annual growth rate of roughly 16%. This step-up reflects Apple's increased investment in AI capabilities, custom silicon, and next-generation devices, as well as continued development across its ecosystem. In contrast, selling, general, and administrative expenses have grown at a much slower pace, at around 6% annually, rising from roughly $5.6 billion to $7.5 billion per quarter. This divergence highlights Apple's ability to scale revenue while maintaining cost discipline, allowing incremental investment in R&D winking and laughing without materially pressuring operating margins. In terms of net income and net margin, Apple has generally maintained a high level of profitability, with quarterly net income typically ranging from $19 to $34 billion, corresponding to a net margin that generally falls in the 23 to 29% range during normal operating quarters. The main exception was fiscal Q3 2024, when net income declined to approximately $14 billion, primarily due to a one-time tax-related charge associated with adjustments to tax obligations in Europe, rather than any deterioration in Apple's core operating performance. Following this quarter, profitability rebounded quickly. By Q1 2026, Apple reported net income of $42.1 billion, with net margin increasing to approximately 29%, driven by record iPhone revenue during the seasonal peak, a higher mix of iPhone Pro models, the growing contribution from services, which carries structurally higher margins, and strong operating leverage during the product launch cycle. From fiscal year 2022 through fiscal year 2025, Apple's reported revenue has generally tracked closely with market estimates, reflecting strong stability and forecast visibility in the company's core business, despite clear seasonality from product launch cycles. Looking ahead to fiscal year 2026, consensus estimates project Apple's revenue to reach approximately $460 to $470 billion, representing revenue growth of over 10% compared with fiscal year 2025. This outlook is driven by continued expansion in services, reinforced by a large and sticky installed base, and underpinned by ongoing premiumization within the iPhone lineup, rather than volume-led growth. Similar to revenue, earnings per share have historically tracked closely with market expectations, highlighting the predictability of Apple's earnings profile. Based on current consensus, EPS for fiscal year 2026 is expected to fall in the range of approximately USD 8.0 to 8.5, reflecting structurally higher services margins, disciplined operating expense growth, and the ongoing impact of share repurchases. Overall, Apple remains positioned to deliver steady earnings growth broadly in line with its revenue trajectory. Investor sentiment toward Apple's stock remains constructive. Based on consensus from 39 analysts, the average 12-month price target is around $296.80, implying approximately 6.7% upside from the current price of about $278. The bull case implies upside to around $350, while the bear case suggests downside toward $205, reflecting a wide valuation range amid differing views on hardware demand and earnings durability. In terms of analyst ratings, the prevailing view remains positive. Based on 50 analyst ratings over the past 3 months, Apple is rated buy, with most recommendations skewed toward buy and strong buy, alongside a moderate number of hold ratings and very few sell views, indicating continued institutional confidence in Apple's long-term fundamentals. Thank you for watching. The information presented in this video reflects opinions at the time of publication, is based on sources believed to be reliable, and is provided for informational purposes only. It does not constitute investment advice or a recommendation.